Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Friday, October 20th, 2023. It is 10:06 a.m. Eastern Time as I'm doing the video, and just wanted to get one out to you, give you my thoughts, or reiterate my thoughts. Last week, I've been fairly cautious for a while, also recognizing, we wouldn't have any very major sell signals till we took out certain key levels on both the Nasdaq 100, which namely is this red line here at about 374 and change. That was and still is the first target from swinging this thing down. We had our initial sell signal there and plenty of others. But as I said last week, it was on Friday, a week ago today, I said I think I think we're there at that point where, the hammer's about to come down on the market. And I still do, and I want to reiterate that. And I also, I wanted to see your feedback. I haven't, the comments have gone completely dark on the last 3 or 4 posts. And I, take that as a sign of, I hate to say it this way, almost good for me being short. And now, obviously, I've told the last couple of days, even stacking on, and playing in that even more. It's still not that all-in moment, but it's still, as I said, I'm kind of morphing more away from active trading, this little range we've been in, to more, especially in the long-term accounts, pretty aggressively short, with a little more room to add. I don't. If the majority of those listen to my voice, or anybody, if you want more long side trade ideas, let me know. I don't put them up there if I don't believe in them. So, and I'm not seeing a lot, and I just continue to see more and more check marks. And why I'm saying this, it's if I'm right, the opportunities are big. This is where traders, when you get these strong moves in the market up or down, they tend to come, especially on the downside, they tend to come very fast. And you can make in a matter of weeks what you'd make in many months, sometimes even years, on trading being invested in or or holding the S&P 500 or the Nasdaq 100. In other words, I see plenty of downside. Even an elevated risk of a crash, swift and sudden move down to any or all these targets. These are just near term. These are the daily charts. I'd still have much longer term bear market targets. And, if it's a big if, guys. I know it's a very big if. If I'm right, and this was simply a bear market rally with new lows to come in the market, then the profit potential is great. And again, stocks tend to fall a lot faster than they rise. So, we could get down there a lot faster than most think. And that's, just to retest those lows from the October lows from where we're at today, not even grabbing the highs, just where we're at this moment, that's almost 30% downside. So anywho, let me go over the charts, let you decide what to do. And maybe that's just a function of people not wanting to really engage this market at this point in time, because it is trending. It's trending down, but it resembles more of a bull market correction. Maybe that's what most believe. But again, I think there's somewhere, and not just too far below, again, I've been covering this for months now, levels that if and when taken out will start that kind of waterfall selling, where it won't just be this kind of orderly downtrend here. It'll be a more impulsive move down. So right or wrong, we'll see. Time will tell. But I try to share my thoughts each and every day, and that's what I've been saying. Oh, and so since last Friday, it's not as if that hasn't panned out. Now, I wouldn't refer to this as the hammer coming down yet, but this was Friday, and it's been just about nothing but red sticks. We had one little green candle on Monday. Other than that, it's been a steady move down. So this is where I kind of called for. It's not even a top. The top, if the top is the top, it's back here. I'm talking the beginning of a more powerful drop, one that you want to be short on, and not, I've seen a lot of people, get upset when even if you've had iron fist and you've shorted those initial sell signals, you're profitable. You're very profitable, but most people don't like. It's these counter trend rallies, not just in time, several weeks there, but also the magnitude there. And again, when we get into, if and when we get to where I'm talking about, you don't have many of those. You won't for a while. It'll be what I call mostly unidirectional drop. At least that's what I suspect. So we'll see. Let's just talk pure technicals. Okay, so yesterday in the videos, again, if anyone even watched them, I've highlighted this triangle pattern here on QQQ, and that's been broken. There's a sell signal. There's an objective level to add on to shorts, but there's something else I'm going to get to I really like here. Let me just finish up with QQQ, and you can see it. I also drew these blue lines here and said that's it. So that's it. That's a breakdown. There's a trend line that had 3 distinct reactions to help validate it. We broke it. And remember, we also fell back down below this. We're in that trading range now. And as I said, that's going to increase the odds that we go on down to the bottom of the range. And if we get anywhere near the bottom, I think that's just going to, I think it will start to snowball the selling. So I don't know, hopefully, well, for me, for my sake, hopefully I'm right. And, if some of you want to trade accordingly, again, this is where the big money's made, and when we get these things, and this is why I do these videos and I talk, and sometimes maybe it seems like I'm rambling, but I'm not going to get very complicated on this one. I've covered everything, many different sectors from home building. We started shorting the home builders right off the highs when everybody was saying the home builders are resilient because they have so much demand because no one else is selling their home on existing homes. Boom, that was the top in the home builders. We did the same thing a couple months early on the leisure and restaurant and leisure stocks, travel, airlines, while they were soaring and roaring, and everybody said, oh, the consumer's so darn resilient, they're just going to keep spending, and boom, that was the top. And now this is the latest here. I started picking on the financials recently. Through my all those breakouts we have failed now. And remember, this is one sector, and I keep saying it's an important sector, very important. As far as the economy goes, this is more important than the tech sector. However, the tech sector is much, much more important for the stock market. So, but I promise you, when the economy rolls over and breaks, and we're clearly, and then there's this, they get rid of this, oh, the consumer's so resilient, they're going to keep spending, they're going to hold this thing up. Once it's clear that the economy is beginning to roll over, or there's problems anywhere, again, I've talked about it, there's a gazillion and one things that can, and many have already broken. Let's not forget, earlier this year, 2 of the biggest bank failures in U.S. history. 3 big banks went down. All right, so here's what I'm going to do. I'm going to finish up here, but just let you know that the breakouts, I took 3 bank stocks the other day, last week, JP Morgan, Bank of America, Citi, they've all failed their breakouts. Remember, I'd been bearish on the sector and short up until then, and not that whole time, but quite a bit of it, and highlighting these developments one after another. This was a beautiful triangle pattern, a very, very clean, well-defined downtrend line. And, if you're new to this is what I do. I analyze these charts, and what I always say is the more reactions that you have on a trend line, the more valid it is. The more eyes are going to see it. If you have to force something, is that support, not support? You might. I keep those kind of supports somewhat, like things with 3 reactions. That's a minimal trend line in my opinion. But this is the bear market downtrend line in the financials, and again, it was highlighted here recently. So just like the NASDAQ 100 when it hit the trend line recently, those are objective short entries. And then we went on to break down. I highlighted that. That was a sell signal. Then we had a snapback rally. We back tested. That was another objective short. Then we had this minor trend line. Remember, and a lot of the market leading FANGs, I highlighted these trend lines as well, comparable. We had these little miniature uptrend lines, mini trend line, but well defined. And look, that broke down, and this is just impulsive selling. This is the financial sector, and again, it's much more important that it shows if there's problems in the banking system, everything comes to kind of a halt in the economy. And I know there's been, and this Fed, oh, don't worry, it doesn't matter, Fed will save the day, Fed won't let the banks try. do what you want. If you're gonna, if that's your trading style to ignore problems in certain sectors, or even in the stock market because of the Fed put, what used to be known as the Greenspan put, and now it's a Fed put. Then, all right, more power to you. Anywho, I'm just showing you the facts, and I'm showing you there's something rotten in the state of the banking world, if you will, and financials. And so you've had many, all along since I started highlighting this sector, giving you these, off the high. So this was just a updated trade idea, if you will. And I didn't have this beautiful head and shoulders pattern when I first started highlighting the financials as bearish. This is Visa I just jumped to, one of the biggest, and XLF, the financial sector ETF. So remember, the financials consists of both banks and non-bank financials. So like Visa is a non-bank financial, and just what a beautiful pattern. Like I said, you turn off all the lines. Maybe, if you're new to this, you didn't see what I saw yesterday. I tried to put out there, but there's so many annotations. You can use a downward sloping neckline or a horizontal neckline. Either one, doesn't matter. Head and shoulders consist of both are valid. Either way, you've got just the beautiful formation there, and then both necklines come in together. And I've always told you, one of my strategies I like when I see a head and shoulders forming, if I have a high degree of confidence, what would give me a high degree of confidence this one's going to play out? Well, the fact that it's not just that. You turn on this board, you had a beautiful, as I said, beautiful textbook, giant bearish rising wedge with big negative divergence. Sound familiar? It's deja vu. Look at Visa, like I said in the post yesterday, and MasterCard. They both had identical big old bearish rising wedge, well-defined uptrend lines, clean negative divergence, and those stocks fell 30-something% then. I'd see at least that much, if not more now. I give you initial target zones, and just to kind of decipher this. Head and shoulder measured target. That is, you take the widest part of a head and shoulders pattern. If there's your neckline, I'd use the horizontal neckline. You take the distance from the head down to the neckline, and then you add that to where the pattern breaks down. Now, I am what I call an anticipatory trader. I anticipate things, even chart patterns, before they are fully developed. Whereas most conventional traders going to wait. If they see, okay, it's maybe a head and shoulder, I'm going to watch. I want to see some of the criteria. You want to see increased volume on the formation down from the head to the neckline, and then again on the right shoulder. And that's what you had there, and that's what you have so far. That's one way to confirm a head and shoulders, because a lot of people, these are like ink blot test, the Rorschach test, that some people see what they want to see when they look at a chart. But, if you want to increase the odds that a potential head and shoulders pattern is going to play out as such, well, then confirm it with volume. Like I said, those are your two volume criteria. You want to scrub it. You want to ideally see increased volume on the formation off the head down to the neckline, and then again off the right shoulder down. And so what I've shared many times in the past, when I see a pattern that I think has a good chance of playing out, I'll short off the right once the right shoulder's formed. And yesterday I mentioned I kind of get in early, and I also mentioned these guys have earnings coming up. So there's a lot of risk, and certainly when you have earnings, it could go the other way. But as I shared in that post, and I've said many times over the years, to go long or short a stock right in front of earnings, or to hold it into earnings as a swing trader, with just a random chart, which first of all should never be in a stock if the chart's not clearly bullish or bearish. But let's just say that you look at a chart, and because I look at thousands of charts a week, different time frames on different things, and 90-something% of charts I don't have an opinion. People ask me, what do you think of XYZ? I don't, I can't. So it's only certain charts I look at that I see things that are clearly bullish or bearish. And if I can't make a clearly bullish or bearish case, then hey, I don't have an opinion. Just go up or down. So those, it's completely random. It's like flipping a coin going into earnings on a chart that's indeterminable, not bullish or bearish. But those that are clearly bearish, like this, Visa, MasterCard, or clearly bullish, that's usually, not always. There's a big difference between usually and always, but usually means much more than 50%. Always means all the time, 100%. So usually the stock is going to go the direction If the chart was clearly bearish, that's going to be the ultimate outcome. And when I say ultimate, I made very clear to not any initial aftermarket or pre-market pop or drop or even a one-day, shakeout move. I'm talking the lasting trend, whether it's immediate or there's a little kickback rally, and then we do that. And again, and the whole usual versus always part, that's what stops are for. If wrong, guess what? You stop over the right shoulder. If they take that right shoulder out much more, it could have gone up a little more and stayed symmetrical, but you certainly can't go over the head. So that's it. And if these guys rock it up, after earnings and do this, and they stop out, and that's it, well, you'll hear no more of it. The trade will be stopped out and move on to the next one. As of now, like I said, there's just a lot there. And this is what I wanted to get to, and then I'll shut up and get the video out to you guys. So this was a textbook, good enough that I even took it, and I said as a hedge, overall I've been short tech, short the market, but these financials had these beautiful, positive, bullish divergence. Beautiful, there's the positive divergence. Test right off, they just recently tested the key 200-day moving average, where buyers almost always come in, especially in a bull trend, and buy key stocks and the market. And so you had the intersecting 200 simple and exponential, and you're back there again. They could still pop it up here. So I'll say that. However, this to me is textbook bear market action. It helps support my thesis that we're, what we saw the October 2022 lows, or 2021 lows, 2022 was a bear market rally, because in a bull market, you get this kind of setup in something, that is the catalyst to new highs. And it still could, because look, let's turn off all my lines real quick. Some people, a lot of people, most people don't see what I see in the charts, and maybe I'm right, maybe I'm wrong. I'm certainly wrong a lot. We all are. But, this is, traders are looking, they could step in here and buy JP Morgan at the 200s again, just like they did here. It wasn't the first one. They stepped in certainly on the first tag of the 200 simple, the blue line, and they rallied it, and then they came and tested again. They even had one of these, which you almost have to count on nowadays, the algos, the market makers, they'll take things down to clear out, and what that does, that's a beautiful little stop clearing move. It sucks in short sellers that see the 200 taken out. It blows out stops on a lot of longs that are very disciplined, have their stops there. And then those nefarious forces, the big, huge trading firms that have enough money to move the market by, there's sometimes they outright sell. Sometimes they, what do they call that? The spoofing, where they flash orders, sell orders. You see on level 2, looks like a big block that's, there waiting for sale to be filled. And then they yank that order right away before it's actually filled. There's all kinds of shenanigans they do. So anyways, but the bottom line is when it recovered, and here's your thing. So let's just say you were a disciplined trader, and there's nothing wrong with that. You stopped out there, or you shorted it. Well, when you saw the recovery back, especially on a pulse of recovery, that's just right away, get out. It's just like that, that line from the movie Heat I told you recently. If you don't get attached to anything you can't walk away from in 30 seconds if you feel the heat around the corner. That's it. And that's the same with these financial stocks. I threw them away because they failed to break out. But if they rally back off the 200-day, it might be just like this, a second test, and then they go. And guess what? Then they'll start to look good. As of today, they don't look good, because what I see is a breakout. It was a post-earnings breakout, very impulsive. I mean, these stocks were up high. I came this close. I'm holding my fingers like a little pin, this close to selling that pop. And I'm like, you know what? I'm just going to keep these on as hedges, see if they can play out. And they didn't. And they back tested, and okay, all right, so we're back testing. Sometimes you break out and never look back. Sometimes you break out and you come in for a back test of the downtrend line or the wedge. And but today, yesterday they failed the back test, and then today it's a clear failure. So yeah, that's glass empty. That is bearish, 110%. Like I said, you can make a bullish case to buy here if you just turn off all the lines. And again, a lot of people don't see what I see. So maybe if the majority of market participants see this and they just see another test and they missed, the first time we tested the 200s, they're going to step in. I would be surprised if the buyers didn't step in here. But if they don't, see, that's the signature of a bear market. When the buyers dry up and they're gone and you have more sellers in the market than buyers, ultimately that's what causes stocks to go up and down, supply and demand. whether you're selling widgets or buying and selling widgets or buying and selling stocks and bonds. And when you have more buyers, it's going to drive the price up, and you have more sellers. So that's, this is tape reading, good old fashioned tape reading. So if they, drop on through there, I already see the failed breakout in itself right there. And so that was a red flag. And that's why I'm doing this video. Especially again, with such a textbook, beautiful setup. The earnings were great. Bank earnings, I didn't dig through each one, but I just scanned the headlines and they all beat expectation, had good earnings. I know JP Morgan was downbeat. He's been cautious for a while, and rightfully so. This economy has defied just about all metrics, all known, with the rise, we're talking about with the rise in interest rates. But again, it's a lag effect. And it just shows that how much money, how much stimulus, if you're a doctor, it's how much epi you pumped into the patient, you give them enough epi, they're going to friggin' jump off the gurney. But you put too much, you're going to kill them. And that's what they did, when COVID hit. I'm talking about the overstimulating the market and the economy. So they overdosed the epinephrine, and which is adrenaline for those who don't know. And so that's the market that we've had since, and now it's starting to wear off. So okay, let me move on. So JP Morgan, Visa, MasterCard, I've given you all these. Berkshire, just look what's happening here in the banks. And I don't know if it's being talked about elsewhere. I've been talking about these financials for a while. Just beautiful, big, beautiful bearish setups. I mean, this is on a scale of 1 to 10. This is a 10. Berkshire was highlighted as a short there. Then it went down, an impulsive leg down, set up this bearish pennant, and just broke down. This is textbook. Broke down 3 days ago, and the measured target for a bearish pennant, it's just like a bear flag pattern, same thing, is down here. I'm just eyeballing. These are my targets that I have, and I'll, the way you do it officially, if you want to get an exact target, just take a trend line like that, measure the flagpole, and then add it to the highest point. So there's your measured target, and there's also, you can see some reactions. And based on this, I'm going to put a line there. That's probably what we'll hit. Why? Because the nature of bear flags and bear pennants is it consists of 3 components: the impulsive leg down, i.e. called a flagpole, followed by a period of consolidation in an upward fashion that takes place on declining volume, and then followed by a breakdown with an equally impulsive move that usually typically mirrors the other one down there. So, and because of that, then you have what I call, again, another made-up term, momentum-fueled overshoot. We have a lot of downward momentum and velocity coming in there. You'll tend to overshoot probably that 320.64. Now, so what happens? How do you trade that? When they start getting down there, what I'll do is start one of 2 things. I'll either have a hard stop, a hard sell, buy to cover, sell limit order, or buy to cover, not sell, buy to cover limit order to close the short just right above the actual support level. Or what I'll do sometimes is get down there, then I'll just pull that limit order and just set a stop loss order to allow it to continue to run. And I'll just ratchet that stop down manually, or I can set a trailing stop, like a 1-2% trailing stop, to follow that momentum and let it ride down. But either way, the takeaway here, I'm just trying to show you, these are the check marks I've been talking about for many months. I said, all these things I've been covering, my things to watch list. And this is the check marks on the financial system. This isn't, you see there's 11 sectors in the S&P 500. One of the smallest ones, let's say, the materials sector. You see, certain things like that. Utilities, they're all important. Utilities, which have been killed, real estate, REITs. But this, again, just because it's not the largest weighting doesn't mean that it's not one of the most significant sectors. Because when the banks have problems, lending is curtailed. So you've got a perfect storm for the economy is shooting relentlessly, rising interest rates now, coupled with increased lending, retraction and lending standards. Banks have to tighten up the belt because of that. So anyway, that's that. So problemos in the banking sector. Bank of America also failed. beautiful breakout, couldn't hold it. That's a failed breakout. As I often say, fewer things in trading and investing are more bearish than a failed breakout. There is a little gap there, so it's at support too. But the only way that I can make a case to buy it now is if this is a whipsaw and then we go back up and really take out these other highs. But it is what it is. As of now, as I'm talking, let's just keep it simple. As of now, these are the failed breakouts, and that's bullish, especially in light of just they were beautiful setups. But I was skeptical along because, we're in a bear market. And again, this is what I'm trying to say. This is a signature of a bear market. It is a bull market in reverse. And you're going to short in a bull market, bearish rising wedges and, head and shoulders and other things like that. And one of two things is going to happen. They're either not going to play out at all, right when they break down and trigger, or just as they start to get going and look like it's going to play out, they usually fall short of their measured targets. The buyers usually step in early. Not to say that you can't trade those, and we usually do. You just have to be more selective. And you also have to kind of err to the side of caution on your price targets. So again, it's just something to look for. And when you see that, when you see one bearish chart pattern after another fail, in an uptrend, recognize what it is. There's a lot of buyers on the sidelines right now, a lot of buying pressure. But likewise, in a bear market, when you start seeing textbook looking bullish setups like that fail, that helps confirm that, hey, guess what? Probably not over. Now, again, these guys are at support. Maybe today is the whipsaw. We'll see. But again, as of now, in real time, as I'm doing this video, that is bearish unless, I told you that, this proves to be a little one-day whipsaw here. Wells Fargo. Let me just show you one more thing on the banks, what I've noticed today. I'm typing in XLF. Now I have it sort the watch list. I was just showing you by the largest components. That's what we just went through with Visa, MasterCard, and the big banks. Now I'm sorting by today's losers. And this is Regions Financial. I actually used to work for this bank as a stockbroker with their investment program. And so it's a big one. And but look at this. They're down 14% today. Okay, there's something going on here. I don't know if there's headlines. I didn't check. It doesn't matter. Yeah, there's some support there. But, this is just, the banks the Fed came in earlier this year and, set up a plan to rescue the regional banks. And, the fact that their Regions is now visiting that low from earlier in the year when the banking sector collapsed. Something's going on here, guys. It's not good. Comerica, 7% drop. Just took out the recent lows, clearly in a downtrend. A few weeks back, a couple months ago, it's time to start shorting these regionals again. This whole rally had reached, what I believe the end of the run. We had bullish divergence there. I mentioned that back when they all put in the divergent lows too. So that's it. I'm just seeing, like I said, these are yellow or red flags, whatever you want to say. I'd say at this point in time, they're still solid yellow flags, not complete red flags. You start taking out additional support levels, and that really makes it a red flag. So there it is. And again, that's one sector, and again, it's an important sector. And you go back to QQQ. So what does QQQ need to do? For the bulls, this needs, just like with the banks I showed you, Bank of America, Citi, and the others, they need to reverse those breakdown candles today, the failures, the ones that in QQQ, what QQQ would need to do. Remember, it hasn't taken out this level yet. So as bearish as I'm getting right now because of these additional check marks, really, the theme here is, or the most important thing is, just like back here when we're coming out, I said, unless we take this level out with conviction, that was this reaction high here, and of course some other, I said, this is where, and we went long there, and we knew that, I figured there'd be a bounce, and there was, and then it went up to there. That was the max target back from here. But the same thing holds true. So we're right there. So I'm obviously becoming increasingly bearish, as I've have over the last couple of weeks, particularly on last week, Friday. Told you this week would probably be the week it starts, and I think it has. It definitely has. Like I just showed you, we're down this week, so, considerably. But when I'm talking about the hammer dropping, yeah, that probably, well, maybe this is the start of the hammer drop. But again, take those levels out and then just go to those big fangs and watch those purple levels I gave you that, if this chart loads, they're quite a bit lower. But again, you had these initial, was highlighted last week, all these little minor uptrend lines, and they all broke and we're moving lower. And so that's it. Let me see if there's anything else significant to cover. No, I think that's about it. So let me wrap it up here, get the video out. And like I said, give me some feedback. Oh, and remember, of the trade ideas, I mean, you can just keep it easy and short the market. S&P, NASDAQ 100, gave you this trade idea recently. And we've also gamed it. It was a long here to go long on the support zone, anywhere from the top to the bottom with a stop below. So we had that run. At that point, told you was prudent. We hit support markets. Told you I turned around, went from long to short the VIX. I trade the futures, but this is the ETF for you guys using that don't use futures. And then look, we've now taken out. Remember, it was T1 all along, first target back here, because it was resistance. And the way this game works is resistance is resistance unless taken out. And once taken out, then it becomes support. And so this is a breakout. This is a breakout in the VIX. And that should open the door to T2. And then, today's Friday, so I don't expect too big of fireworks today. But next week, we could see a pretty quick move. When the VIX, once it becomes clear to all, especially when T2 is taken out, that's probably when the VIX, again, if the hammer is going to come down on the market, and we're going to see that waterfall type selling, the VIX could just explode from there. And, that's, of course, VXX. And I said it when I got this post out too. Here's the regular VIX, the spot VIX, which I want to mention too. Remember, on the spot VIX, on my weekly chart that I shared, I had a big old triangle, very well-defined uptrend line here. It broke. I know that charged a lot of bulls, and it was, for that point in time, bearish, and we saw the market rally. But since then, as pointed out here, we put in a divergent low. We rallied back up. We've been back testing it, and boom, now we've recovered it. We're back above that trend line. So now this whole thing is a false breakdown, aka I'll say bull trap. Normally you want to say bear trap when it goes down, but it's really a bull trap because remember, the VIX is the stock market in reverse. So when this happened, stock market bulls said, okay, this market's going to new highs. We're in a bull market. Volatility is low. Now this is their rut row moment where and the VIX, just don't underestimate the VIX, just how far and fast it can go when it wants to run. So, all right, guys, I'm going to get it out to you again. I welcome comments, feedback. If you disagree, you don't want to short, you want some long trade ideas. There's been plenty of those. Commodities are really looking good. By the way, somebody asked yesterday, those ag commodities, and I replied in that post, DBA is, if you want a one size fits all, it's the ag ETF. It has, here's why, because my question was oil. In fact, I told you I'd shut up, but I'm still going. Crude oil looks like a short right now. Here's a 60-minute chart of CL. Not a screaming short. USO, I can't make as good a case. But again, USO just tracks the futures anyways. So you have a first time in a while, you have a nice, well, we had divergent there. And we did, and we got a correction. That was DH1, and this is just DH2. The divergence has been extended. So a nice target here. Now, so where I'm going with that is, I'm short crude as of this morning. And lately I've thrown out several trade ideas recently. Wheat, I told you recently in the last update, couldn't get out of its own way, but it's starting to firm up. We had that trade on coffee, which did well, and still running. Coffee, don't underestimate. I really like, by the way, the long-term chart. I think coffee can continue up. Coffee, when it wants to run, it's kind of like natural gas. When it picks a trend, it can just hold on to that trend and just run, become overbought. Here it is. Here's the chart of coffee. And you can see there's an example, T1, T2, T3. This thing's rocketing. up. And so that's just, pointed out here after the breakout here, wherever it was, there, you could see the downtrend line off the divergent low. Maybe it was on that initial breakout there, and then we put in a additional divergent low. Either way, so this is the move in coffee just in the last, you don't hear about this on CNBC and Bloomberg. They don't talk, about commodities, and I just like trading where the opportunities are. And what I'm trying to tell you is, if you don't like shorting the market for whatever reason, there's other places to make money. So this is where I'm comfortable. Longs, is it objective here? No, it was objective down here after the breakout, but it's continued to run. And again, the long-term chart's constructive. This thing can continue to run. And then you have the other ones like wheat, corn, soybean. Remember, wheat, I'm talking, it's just been building these divergences, building. And we've had rallies, and we've gotten out too. We got, we traded this, we swing traded, got here, and then I mentioned we hit it there to short it down. So we've hit these targets, but here's what it looks like on the 60-minute chart. I know I'm all over the place, guys. I must have thrown these targets out to somebody or shared them recently, T1, T2, T3, T4, and we're coming up on that T1 now, and we're starting to see there. So what I'm seeing is, I think it's time to get out of Dodge in the markets, and then 401ks, all that stuff. I'm just giving you my 2 cents. I can't tell you what to do. Where the opportunities are, if you want to, other than 5% money markets, 5.5% money markets, which are great, if you want to sit it out. I do see opportunities in the ag commodities, and like I just showed you, DBA, I'm favoring over DBC. DBC is a broad base. There's a lot of them out there. But DBC and GCC, these are all the broad-based commodity ETFs. I mean, this one doesn't look bad. This is GCC. Look at that basing pattern there, guys. Boom. A lot of upside there. And it's not overweighted. This one actually, I like it. I'm just looking at the weight. This I haven't updated since 2019. You probably can't see it in the video, but it was 24% softs, 23 grains. Only in energy, only 15%, and that's actually not bad. A lot of the others, the broad-based that track commodity indexes, broad-based commodity indexes, like DBC, the DBC tracks one of the major commodity indexes, but it's 50% energy. Gasoline, WTI crude, Brent crude, natural gas, and so. If crude starts to stall out here, which eventually it will from demand destruction as the stock market tanks and the economy comes, and then the talks of recession really start heating up, then you might want to not be overweighted or so top heavy into energy if you like the commodities arena. And that's why I shared with you a minute ago DBA, which is only agricultural commodities: live cattle, soybeans, sugar, corn, cocoa, wheat, coffee, lean hogs, feeder cattle, and cotton. So there you go. I will wrap it up here. So there's what I like and what I don't like. Again, if you have any feedback or comments, let me know. This has been Randy Finney with Right Side of the Chart. Have a great day.